Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with Joe Cordell, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of ElderTalk. This week we're going to talk about something that we know is near and dear to your heart, at least dear. I don't know that it's near your heart, and that's the issue of finances. And we know that when you look at any survey of people as they age, people who are nearing retirement, people who are in retirement, when they list their concerns, almost always first or second on that list, it competes with the subject of health. Health and or this are on the first two items on the list. So we wanted to have someone on today who can talk about some strategies, some important things that people need to do as they think about retirement, but also let us know about what changes in a portfolio may be in order, or maybe just changes in investment philosophy in more general terms. In light of the changes that have occurred in Congress last year, there were tax changes. There's a new economic environment in many ways. Healthcare insurance has changed. So as people think about how do they budget their money, where do they place it during these very uncertain times, presidential election year, we wanted to get somebody who we felt could be most helpful to you, our listeners. And you want to tell us, Jill, about our guest?
Yes, we have John Gallia with us from Gallia Wealth Management Group. John, thank you for being with us today. And it's the new year, and people are in the midst of their New Year's resolutions, weight loss, exercise, but why not making a financial plan with the new year?
Yeah, absolutely. Well, first of all, thanks for having me. But yeah, financial planning is essential to everybody's well-being. No matter what age you are.
But a lot of people don't do financial planning.
It's a scary subject. It's hard to dive into because when you look at financial planning, you have to look at 6 different aspects. You have estate planning, retirement planning, insurance planning, investment planning, and tax planning. So all of those things work together to come up with a person's financial plan. And if you've heard the saying, paralysis by analysis, all right. A lot of people get that.
Sure.
And some people it's just paralysis.
Some people it's just paralysis, absolutely. But there's so many things that people need or people feel like they need to get done. They don't start on anything. And that's the worst thing you can do with financial planning. And what I always tell folks is there's probably a subject area that keeps you up at night. The one that you're most worried about. It might be investment planning. It might be estate planning. It might be insurance planning.
So, when you define it that way as these series of subtopics, then I can see how probably it's more accurate to not just say financial matters, but one of these particular components is more likely the one that a given person will focus on.
And I can see why it would be overwhelming.
Sure, absolutely. People just don't know where to start. But obviously, I think the best place to start is the one that is most pertinent to you or the one that keeps you up at night. And the saying is, how do you eat an elephant? Well, one bite at a time. And probably some of the best advice I can give is if there is an area that you feel like you need to concentrate on for 2020, take time and devote it toward that one aspect, that one area. Take 2 or 3 months and work on getting your financial plan in order in that area before you tackle something else. And that's a good way to prevent that paralysis by analysis feeling.
And I think that a lot of people, though, are frustrated with the fact that they don't know who to hire as a sort of central manager, a stage manager of these various activities. Like, for example, tax issues. They're thinking, should I go to an accountant? Well, the accountant won't be able to help me with my legal needs, so now I've got to go get a lawyer, and then the lawyer won't be able to help me with my financial planning, so I need to go get this third guy. It's frustrating to have so many people involved. And for somebody who's very wealthy, they may be used to living in a world where they have multiple important roles that have to be filled professionally. But even they probably have somebody central. But especially for many of our listeners who, for the most part, are not going to be rich. They're going to be people who are middle class and who can't afford to have a variety of people involved in their life. how much can they count on their certified financial planner? And I don't know if we mentioned, Jill, that John's a CFP.
Right.
So a certified financial planner, incidentally, is a marvelous credential. I've mentioned this on the show before. It's the one that I respect most in the financial planning field because of the difficulty of getting it. I compare it to a CPA. So people who have a CFP, it doesn't mean that they're always right, of course, but they're more likely to be right than somebody who doesn't have a CFP.
Okay.
But anyway, so how much can someone rely on their certified financial planner to accomplish these subcomponents that you mentioned? What role would they play in all this?
Sure, and I couldn't have said it better when you talk about the CFP. I'm pretty humble about that designation, so I appreciate you kind of going into further detail about how important that is when you're looking for a financial planner. The CFP, in all essence, is the puppet master that pulls the strings. If you go see a CFP, they should look at your financial plan from a holistic standpoint. They should see areas where there's gaps. And typically CFPs work with a network of other folks that they can refer you to.
Such as attorneys.
Such as estate planning attorneys, such as CPAs. I can't count how many times my clients have come to me and said, hey, do you draft wills and trusts? And I say, no, but I know somebody that can help you.
So you can provide guidance.
Absolutely. That is essential when you're looking for a financial planner.
Yeah, that's the critical piece, and is that to have one person who is in the center and has this familiarity, who's conversant with these other components, and they can communicate and everybody's on the same page rather than having four different professionals that the client is on their own to communicate with and to translate what they heard from one professional to another. You really need somebody in the center, and the CFP is the logical choice for that role.
Somebody to help you navigate through this whole process, which can be very complex.
Yeah. And some lawyers might purport to do that, and I can speak objectively on this because, when I step back and look at it as a lawyer and as a CPA, the logical choice is the CFP. They're the person who is dealing with enough of the subjects to where they can be in the center of that activity and be directing them to their attorney for the legal issues, et cetera, and to the financial piece, and the CPA typically be involved if there's much tax planning. Some people don't need to hire an individual CPA. If you're middle class, you may not have a need for a CPA. It might be that the certified financial planner can refer you to tax services that are less expensive.
Yeah, that's absolutely correct. I think the CFP or your planner should be able to kind of see what you need as far as if you do need a CPA. I've had some folks that are very much the do-it-yourselfers, but they have something coming up in their life that they're going to need some outside help. Maybe they're selling a renter home. Maybe they're having another child. That person should be able to tell you whether or not you should be doing something like this on yourself, or would it be better in this instance to refer you to a professional. In addition, that planner should be able to relay information to that other professional. A lot of times in this industry, we have certain terminology that maybe if you're not in the industry, you don't understand. And it's good to have that interpreter working as a middleman to help you get what you need. And I see that all the time. I see that, have you thought about your beneficiaries for your trust, or custodial folks for your trust, or who's going to be medical directives, or why you need a living will? These are all things that your planner should be able to interpret and help you at least get to the right person that can help you with that aspect.
So let's talk about how certified financial planners are paid, so that people understand this field as they shop for somebody that they want to use. There's fee-based, and the alternative is what, commission-based?
Commission-based. So how that worked out is, I want to say probably 10 years ago, everything was commission-based.
Now explain what that means.
Commission-based means you're going to pay for transactions when it comes to investing. So when you buy something, your financial advisor is going to charge you a fee to buy that. Or maybe it's a mutual fund, maybe it's a stock.
Is it like a percentage?
Typically, yes. It would be a percentage of the amount you purchased. And then on the flip side, if you were to sell it, they would also charge a fee. The Department of Labor a couple of years ago kind of saw issues with that, where a financial advisor might be churning or buying something and then selling it right away to generate a revenue.
Yeah, and this is traditional stock brokering as we've all known it, as that most of our listeners probably think about is when they think about buying and selling stocks as perhaps they did maybe 30, 40, even 50 years ago, then it was the standard way of doing business. You pay a commission every time you buy or sell a stock. And you can see, I think everyone gets it, that there's a temptation on the part of somebody who's paid that way to engage in more transactions.
Sure.
Because that when they sell more and buy more, then it produces more fees. And I guess that was the concern, the regulatory.
Yes, that's absolutely correct. That was a concern. Probably right around 8 or 9 years ago, you start seeing professionals charge just an advisory fee, and it might be based on the assets they're managing, or if they're putting together a plan, just a flat fee for that plan. The DOL likes it. I think it's a lot cleaner. It takes away alternative motives. And a lot of the transactions that you do within a portfolio, the trades, are now free.
Yeah. So, and there's two other ways of doing this, of having compensation. There's the commission method in which you just described, which is the old traditional model. And now let's talk a little bit about a fee-based alternative.
Sure, yeah. How that works is that's a contract between the client and the financial advisor to offer some sort of service for their client. Most of the time, it's through managing of assets. Obviously, the more assets you bring over for the financial advisor to manage, probably the lower the fee gets. It can also be for doing a financial plan. Some of these holistic financial plans that I put together take 8 to 10 hours of work and research on my part. Well, somebody's going to get compensated for that, obviously. So it's a contract that can be negotiated by the client and the financial advisor.
So the cost will vary, I assume?
The cost will vary, absolutely. And I always think of you're going to get what you pay for,
Yeah.
So folks can be a little cost sensitive, and financial advisors completely understand that. But you don't want somebody doing or working for you for free. Chances are you're probably not going to get their best effort. So there's a little bit of cost that goes into it. And really the reason why you hire a financial planner to handle your assets or to manage your finances is because we do take the emotional side away from investing. We look at logically your needs, your long-term goals, your wants, and we invest accordingly. And that's important to consider.
Yeah, and I would mention a couple of things, though, to flesh out what we're talking about here so people get it. Whenever you're talking about commissions in the traditional sense, I think people understand that. It's a little confusing, though, when you talk about fees, because fees, I know you meant that fees can be in a couple of different forms. And one, of course, is that you pay by the hour or by the project. So this is kind of like a lawyer might bill you. So you go to a certified financial planner. You say, I want to develop a plan that's going to be comprehensive. And that's the beauty of financial planning if it's done in the hands of a CFP as opposed to a stockbroker who claims to be a financial planner. That's a phrase that can be liberally used. The law permits that. No one can walk around saying they're a lawyer unless they're licensed and certified through a state bar.
Sure.
But people can walk around and say that they're a financial planner or use the word financial advisor with impunity because it's a murky term. And unfortunately, a lot of people turn to, for example, a stockbroker thinking that this person is a financial advisor in the sense that a CFP is because they say, I'm a financial advisor. But a CFP, to drill down a little further from where we were a few moments ago, is somebody who, in this test that I referred to, it encompasses training about insurance. It encompasses training about taxes, enough about law to be able to make a decision about what lawyer should be involved in a particular case, or estate planning, a little bit about estate planning. So there's this circle of financial stuff, the things that are likely to be most important to in people's lives. And in each of those are each modules that have to be passed separately as a part of this test. So that's what I like about a CFP as the person who's chosen to occupy this central role and kind of communicates with the other party, for example, the estate planning lawyer. But having said that, so you go to a CFP and you say, I want to develop a plan. So the CFP can do a couple things, and correct me if I'm wrong here, John. One is they can say, well, I'll charge you $1,000 to do this financial plan. I like people who tell me how much and how I'm paying. If somebody says, well, I'll give it to you free, that's part of my services, immediately my defenses go up. Because I'm trying to figure out, okay, I know that this is not a not-for-profit organization. This is not a 501c3. So money's being made here, except this person is not telling me how. So I have to figure out how they're making money. And I like the idea where somebody says to me, this is how I charge you. I charge you either hourly, and that's fine. That makes sense to me. Or I charge you for the project. You want a financial plan. So a financial plan is $2,000 or $3,000. Don't be shocked if you hear a number like that. Especially if the plan includes that entire 360 degrees of all those components that we've talked about here and a few other things. But there's another way they can do it, and I wanted, John, you to talk a little bit about this. It's not hiding the ball if, and I don't know if you approve of this or not, John, but what I've heard some CFPs do would be to say, well, I will include the financial plan if you sign up and I'm managing your assets. So that's called like an assets under management plan where the person, and you referred to this a few moments ago, but I'm fleshing it out, where a person may hand you $2,000 or $2 million or $1 million or $500,000, and depending on the amount, you may charge them as much as, say, 1.5% or 2%. If it's a lot of money, it drops below 1%, I'll bet, in this environment. Then you, as the customer, you know what you're paying your financial advisor with that plan. You know that they're making a certain amount of money based upon the size of the money that they're managing.
It's clearly defined.
Yeah. It's not something that's being made under the table through commissions of selling you insurance, selling you life insurance. Not that that's always bad, but I'm just telling you, you need to be aware that that's a way that money's made, and it should be on the table. It should be up front. But I'm comfortable with assets under management. It makes sense to me that if I give you $5 million and you say, okay, I'm going to charge you 1%, and in exchange for that, I'll do your financial planning. I don't know if you do that, John, but some people do. So that's a plan that I understand and makes sense to me. But people, when they walk into a financial planner's office, they really need to understand this stuff. That's the reason I'm dwelling on it the way I am.
No, I absolutely agree, and I've actually done business both ways. You're absolutely right. If I have somebody that is really wanting me or to take them on as a client and wanting a financial plan, I'm more than happy to. And then there's folks that are interviewing me and seeing how I can help them, and maybe they are the do-it-yourselfers. Maybe it's a young folks that are heavily involved or heavily weighted in their 401k as far as their investments, and there's not much money for me to manage, but they still want somebody to look over their accounts and look over their financial situation. So that's going to be a little bit more of the fee-based, all right, this is what I charge an hour, this is what I charge a plan. But I think everybody that has a financial planner working for them that is managing their money probably should talk to that person about getting a financial plan, because what good is having all this money in your investments and growing at 15% or 10% if we find out that the funds aren't being left to the right people based on their wishes, or they're paying too much in taxes. Mm-hmm. So it's really important for folks to take that relationship to the next level if they haven't.
So let's talk a little bit about people who, let's assume that the person that's seeking information from you is over 60. Maybe they are just 60, but the point is they're not in the middle of their career. Mm-hmm. And so some might say it's a little late in the game to do some planning. What do you typically find are the most important things to address when somebody comes in who may be at the threshold of retirement or just retired?
Sure, great question. I always work backwards. When we talk to somebody that is close to retirement, that's a big decision. And that's a tough decision for them to make on many aspects, emotionally and professionally. What I start with is, how much do you want to live off of in retirement? And then we see if your assets or your investments can make up for that amount. we factor in Social Security. We factor in a certain percentage of yield that we're going to get from your investments. We also factor in inflation. Those are all things that need to be looked at when somebody is getting close to retirement.
Whenever you factor in that percentage, it must be really depressing in these environments for you. I mean, if you were to assume that this is going to continue for the next 30 years, then you'd, I guess, assign a return of 1.5% or 2%, which a lot of people must think, geez, I can't retire if I earn this little amount of money. Do you assume things are going to change, that they're going to improve over the next 30 years, or do you use the lower numbers that we would find today?
Great question. I think as a financial planner, that is your decision, what numbers you want to use. But I think having a realistic approach is what's important. You probably shouldn't assume somebody in retirement is going to get a 15% average yield on their investments. If you're assuming that, then you're also assuming they have a lot of money to help support them in retirement. So I think probably a nominal rate of return is advantageous. And this can be anywhere from 5% to 7%. And a lot of the misconception is when I retire, I need to go at least 60 or 75% in bonds or fixed income.
Yeah, you
right?
hear that.
You hear that.
60-40.
60-40, right? Well, we got to look at if you retire at 65, we want to assume when we're making a plan for you that you're going to live to age 90. That's 25 years.
Right.
So there's a lot of inflation that can happen within 25 years. And you're really shooting yourself in the foot if you assume that you're going to go to 100% or a 75 or, even sometimes a 40% bond portfolio, because you need time to still grow those assets. And I hate to be the bearer of bad news, but we're going to see up and down markets in 25 years.
And John, do you ever get clients that have already reached retirement and they have done absolutely nothing? And is it too late with those types of circumstances?
It's never really too late. I think sitting down with somebody and seeing and calculating expenses and cash flow is really important. And there's always adjustments that can be made. There's always adjustments that are going to be made. I liken this to somebody that sits down and we're on track in retirement and everything's going good. Then all of a sudden there's a big expense and it derails you a little bit.
Like it could be a medical crisis.
Medical crisis, a loss of a significant other, something like that. There are always things that are going to derail us. But if you've sat down and you have it planned out, you can make those adjustments, okay? So if you were living off of in retirement maybe $75,000 a year and you had something happen, a big expense, you might be able to make ends meet by living off of $65,000. So there are folks there that can crunch those numbers for you and help you make those adjustments. And those adjustments will happen no matter, who you are at what age.
Isn't your advice sometimes to a person who has done no planning or done very little, they walk into your office, they're early 60s or thinking about retirement, isn't the result of their failure to plan sometimes that they're going to have to continue working, or your suggestion to them is that they put in another 5 or 10 years in order to have the money they need?
100%. It's tough to stop cold turkey and cut your income and 50% live off of that. There's 3 stages of retirement. There's the go-go, there's the slow-go, and there's the no-go.
I like that. The go-go,
explain
the
that.
Logo and the no-go, right? When you first retire, you first want to do everything you didn't get to do while you were working. You want to travel, you want to visit your kids, you want to have fun, you're going to spend money. All right, chances are when you first retire, you're not all of a sudden going to say, all right, I'm going to take half of what I made or half of what I live off of, and that's what I'm going to spend. And then there's the slow go, all right? So you're not traveling as much, you're not going out as much, but you still have expenditures. And then there's the no-go. Obviously you're getting in your late 80s, early 90s, you've had some health issues. Well, you're not traveling as much, but that money that you were spending on those things are now going for medical benefits.
Sure.
Or medical costs. So we still have to plan that in retirement. And I am tentative when I do a financial plan to say, okay, this month you're going to live off of $100,000, but you're going to retire next month. Well, all of a sudden you need to cut your costs by 25%. That's going to be tough for people to do. Your
Right.
mortgage probably isn't going to go away right when you retire. Or if you have a mortgage, all of a sudden it's not going to be paid off that next month. Your grocery bill, all of a sudden you're not going to shop at a different grocery store because I'm in retirement.
Right.
So
Eat less. Yeah.
eat
right.
less, right. Those are all things to consider. And when you do a financial plan, depending on where you're at financially, there might be times where the advice is, all right, I can work an extra year and I will not have to change my standard of living. Or if I retire 2 years earlier, what am I going to do to gap that time between my retirement and Medicare? That's a big one.
Yeah.
Finding that gap, who's going to pay for health care? So those are oftentimes, I don't want to say it's due to a lack of planning or a lack of saving, when you're younger, because we all have a certain amount of money that we can put toward retirement. But I think it's always good to know where you're at and if those adjustments need to be made or would be advantageous.
Does that happen very often? I mean, have you encountered that very often where someone has already reached retirement and they have not made a plan? I mean, do you get many people like that in your office?
Yeah, or, they're at a time in their life where things have slowed down to where they're paying more attention to it. So you get a lot of that. But yeah, I mean, most folks haven't made a holistic financial plan upon retirement. They might have crunched some numbers, might have worked a little bit with software, but they're kind of flying blind at how they're going to live in retirement.
Sure.
And that's probably pretty normal.
So you probably then see people who would come into your office in their 60s. They probably have a house that, if not paid off, should be close to paid off. And their biggest asset, if not their house, is going to be what? Their 401k or IRA?
Typically, if they don't have a pension plan,
you don't see those very often anymore, do you? Are they still around?
you do with teachers.
Yeah.
The government pension plan, and that's a conversation I have with a lot of teachers. They don't have ginormous 401ks like their spouses or their friends because they've been paying 14.5% into their retirement pension since they've started working, which is a pretty large number.
Or organized labor, union workers.
Absolutely. With those pension plans, obviously, we still want to assume that those are going to last their lifetime when we do a financial plan. But you also have to relay to that person that, hey, your $75,000 you're going to get for the rest of your life for the next 30 years is probably the equivalent to a couple $1 million in a 401k. And boy, they are surprised to hear that.
Yeah, I'm surprised to hear that.
Yeah. Well,
sure.
it takes a lot of cash. It takes a lot of money invested to generate a $75,000 a year cash flow.
Yeah, and yet, depending on what municipality or what government entity or what organization is providing that benefit, it probably behooves them to be a little distrustful of it, to acknowledge the possibility that some pension obligations may not be honored. Maybe. I mean, it's a radical idea, but there's been discussions of what happens if we have a real downturn and we have bankruptcy. Will they allow some municipalities like Chicago to disclaim some of their pension obligations? Mm-hmm. Most of those will not be in pay status, but I'm sure some, they would try to get out of pay some that are in. But either way, it's even worse for those who are not in pay status because they're probably approaching retirement under the illusion that everything is in place. So I guess then either way, you have to allow for possible shots out of left field.
You have to in every plan. There's going to be things in life that happen to us all. Maybe it's a loss of a job, or maybe it's a corporate pension plan that has to make cuts.
Yeah.
Those things have to be planned for. So when you sit down and you do something like this, you have to realize that this is a living and breathing document, that you just can't check mark a financial plan off your list and say, I did one once, I'm good. No, you got to make adjustments. Same thing for an estate planning attorney. There's going to be things in life that you may need to change.
Sure.
A will or a trust. So it's great to have it in place, but you also need to go back and reflect on it and make sure things are as they planned. Another kind of funny thing I heard a financial planner say once is, if you start in New York and you want to set sail to London, if you're 2 degrees off, you're not going to land in London, right? And 2 degrees off isn't that much. There's certain things that can happen that throw us off a little bit.
Yeah.
And we need to compensate for that. I once had somebody that lost a job, and if anybody has ever been out of work, you know how anxious that is, or that time is terrible.
Yeah.
Because you have bills to pay, and now you're setting back your retirement. They had a financial plan, and I asked them, I said, "Are you worried at all?" They said, "No, because I sat down, we planned it out, and I know exactly what I need to do to make up for this time. So we can keep our standard of living and whatnot. It's just a matter of doing it." Takes the fear out of it. I mean, and
I
that's,
see that.
That's
so do you
substantial.
contact your clients like every so many years and say, hey, maybe we need to get together, make some adjustments, go over some things? Is that pretty typical?
It's typical of anybody that's fee-based. Typically, if you are a fee-based financial advisor, you have to meet with your clients to go over their objectives and goals once a year. Some clients I have want to meet every 4 months, every 6 months, or maybe once a year is fine.
Okay.
But I would say no less than once a year is a good proximity of when you should talk to a financial planner. And the other thing I will add is, things have been going pretty good in the markets lately.
Right.
So good it makes me nervous.
So good it makes you nervous. Absolutely. How long can it last? But there is a sense of confidence that we've had in the markets. It's good even if the markets are high, even if your account statements look pretty inflated, that you sit down and have these conversations, because things aren't always going to be this good. And we need to make sure that you're on track.
Right, and prepare in case there is a downturn.
And prepare, right, rebalance. The saying goes is everybody has a plan for the chant until they get punched, right? So we don't know when the next downturn is going to happen, but there are a lot of folks right now with portfolios that might be a little weighted toward equity because it's been so good.
Oh,
so
I'm
far.
sure they are. Yeah.
And you have to take in your risk tolerance and look over your investments to make sure that they're still on track.
And the temptation when the market reaches these dizzying heights, and you've had a bull run for going on 11 years now, the temptation is to take money off the table, to put it in some sort of fixed income alternative that may be earning you 1.5% or 2%, but you're thinking, I'm not sure I have enough runway in the event that we have another bear market like we had in 2008 to recover. Because I do believe, I have confidence in the American economy, and I think most experts do, to recover. But for somebody who is 75, that recovery may not be in sufficient time for them to have the money they need to be able to fund their existence, for the balance of their lives.
All the more reason to hire a financial planner to look over your investments, because they're going to look at your long-term objectives. There's a temptation that when you see a 400-point swing in the market to take money out and put that in equity and catch the swing up, right? But you want to stay balanced, even in this time where equities are high. So if your long-term objective is to be a 65-35 portfolio, no matter how hard the market is, you need to maintain that balance. And that's always good to have somebody doing that for you on a daily basis.
So 65-35 means that, so our listeners understand, that if you have a significant appreciation in the 65%, it can become 70% of your total worth or more, and you have to, in that case, when the market's going up, you need to pull money out periodically and put it in maybe your fixed income alternatives.
Yeah, that's exactly right. So when I say 65-35, I was talking about a 65% equity portfolio to a 35% fixed income. So the saying goes, sell high, buy low, right? So if the markets are high, that 65-35 portfolio might have turned into a 70-30 portfolio. It's up to your financial planner to rebalance that. And the good thing about doing that is if it has appreciated or the markets have appreciated, you're going to take 5% of the equity,
Cash
sell
out.
it high,
Yeah.
and buy low fixed income. So that's advantageous to do at all times.
Yeah, and we mentioned before that most folks approaching retirement age or at retirement, their home is paid for or close to being paid for. But there are those cases where people have borrowed against their house and they owe a significant amount of money. How does that impact, their retirement? I can only imagine it makes it much more challenging creating a financial plan.
Sure. The house is a funny thing because paying off a house or something that has that much debt can be a little bit more of an emotional decision than a logical decision. If you still have a mortgage now and you're getting close to retirement or you're retiring, here's something you have going for you. Mortgage rates are low, so you're not paying 8% of interest.
Right.
But it will factor into the cash flow that you're able to take home. So let's say you have a $1,000 mortgage, you're going to have that until that thing is paid off of. And if you're generating, $2,000 or $3,000 in interest, a third of that is going toward your mortgage. So ideally, as you get closer to retirement, you do want to have a significant amount of that paid off. There's a couple reasons for that too. If you need to get money out of your house or if you need a loan, you can get money pretty quickly out of your house at a lower rate than if you were to take or go to a bank and get some sort of loan. So there's leverage you have when you have equity in your house. So there's a flip side. Well, I don't want to pay off my mortgage too quickly, but there's also an element of I need to generate cash flow and make sure my retirement is taken care of.
Also, people should consider the tax impact. They are able to deduct that interest. So not only is it a low interest rate, particularly if they've refinanced recently, they've reached new lows. I think 3% now on a 30-year fixed. I saw the other day. In addition, they get a tax deduction. So that's going to shave off maybe another point. So really, their after-tax payment on that money is probably around 2% or so. So it's very tempting to get. Now, if you make a lot of money or you have a big mortgage, they've lowered those ceilings. So it's not as easy to, what is it now? You can't go above. They lowered it from $1 million, didn't they?
I think they did.
I can't remember what the new law did, but it was that at one time pretty much as you had or over $1 million was going to be deductible, and now that ceiling has been lowered under the tax reform, the most recent tax reform. But for most people listening to this show, it's a deduction that they have, and so 2% for a loan, it might make more sense to have the cash available to live on or for emergencies than to go ahead and pay off the loan. But that's very much, I guess, philosophical, isn't it? Some people are more risk averse.
Yeah, if there's one thing that I'm tentative to discuss with a client, it's whether or not to pay off their mortgage, because that is an emotional decision, and I completely understand wanting to retire and not have that mortgage payment, right?
Yeah.
Right.
I can completely understand that. I can also understand having a 3% loan on a mortgage, even in retirement, if you're able to kick back more money towards your investments and earn 5-6% on average per year. That makes perfect sense too. The thing that scares me the most are folks that are kind of approaching retirement that have the credit card debt.
Oh, yes.
The ones that are 15, 16, 20%. Those are things that you need to get off your plate before you retire, because minimal payments, making the minimum interest payments you'll never go anywhere. You never get out from under those. So I would say those are a little bit more important than, paying off your home before you retire.
Yeah. Dave Ramsey, which I think some of our listeners at least are familiar with. He has a national financial planning show.
Sure.
And he feels very strongly that you pay off debt, period. So it's hard to argue with that. I tend to be a fan of his. So there's the tax advisor in me as a CPA who would suggest that you sort of arbitrage investment return opportunities versus what you pay in deductions and tax savings, et cetera, or interest. So I still think, though, that it does mean living with risk. And a lot of people, especially as they approach retirement, don't want to live with risk. They'd rather get rid of the debt and not have the cash and have the peace of mind.
Sure. And I completely understand that. And I think, you got to look at the audience certain people are talking to. And really, you have to take into consideration how the person views money. So let's say you make an extra $1,000 a month, all right? You have two choices you have a lot of choices, but you got two choices that you can do with that money. You can put that toward your home, or you can go out and you can buy something you probably don't need.
Safe to assume they don't need it.
Yeah.
We're a consumer-driven society. We want to keep up with the Joneses. We want the latest, greatest cell phone, whatnot.
Yeah.
If the decision is I could pay off my home or I could buy a depreciating asset that I'm not going to miss 3 or 4 years from now, absolutely pay off your home. You're going to get more out of that than buying something you don't need. So it makes perfect sense if you're one of those kind of spenders.
And also people are thinking about downsizing, right? So that's a chance for them to lower those living costs and to maybe get rid of a mortgage and to be able to live somewhere that they don't have a mortgage at all because it's less expensive.
Yeah, maybe go to a condo even.
Yeah, I mean, that makes so much sense, but it's really hard. My wife and I are starting to get to this point where we're having conversations about downsizing. So I'll be 62 soon. And so we're asking ourselves or thinking about, which things will we be getting rid of? And your kids don't want them. I mean, those days when kids were young and the chance to have this great furniture in terms of being solid and whatnot, solid quality, maybe not the most contemporary, but good quality furniture, those days are gone. I mean, I don't know how it is, but kids seem to have everything.
They do. They don't want the china. They don't want, anything, antiques.
And that hurts, because
Yeah,
we have our
does.
identity in it.
Right, and you've had, sometimes it's an heirloom that you accepted from your parents or grandparents, and now your kids are going to break the chain because they're saying, well, Dad, I really don't want that. There was this article in the Wall Street Journal last few days, had a picture of this grandmother trying to put her fur coat on her granddaughter, saying, now, I want you to have this. I've decided to give this to you very ceremonially, and you could tell the grandmother thought this was just the most tremendous gift that could
An
ever.
honor, right.
Yeah, and you see the eyes of the grandchild. Yet the grandchild's trying to be polite. I mean, things like furs that have been in families for decades.
Yeah.
So I think downsizing is an important opportunity to make your cost of living much more feasible. True?
Absolutely. And I'll kind of relate to that story. My mother is a collector of depression glass.
Oh, yeah, I'm familiar with that.
The green depression glass.
Yes.
And she has a room full of depression glass. And none of us kids want it.
Yeah. And even the collector market is kind of a little slow on that.
So I kid with her, we're going to have a heck of a day, getting rid of this stuff when you pass. We're going to take some shotguns and throw it up in the air and see what happens. But I tease her with that. But you're absolutely right. Downsizing is always a hard subject, always a hard choice. But there are advantages to downsizing.
Yeah.
That's one of the things that we go back to updating it on a periodical basis, your financial plan. And, one of the things that as a financial planner, we don't really try to factor in, downsizing. But if you have a house that's worth $400,000 or $500,000 and you decide that that is too big, your kids have moved on, you don't need that, and it's getting too hard to maintain, and you buy a condo or go to a community and you buy something that is $150,000, you're going to have a little bit more of that surplus funds coming out of your house that will give you more wiggle room when it comes to your cash flow in retirement.
And I think it's sentimental, though, with a lot of people. I know with me it would be. I love my house, and I just can't imagine downsizing to a condo someday.
See, you're one of those people. Now, I'm okay with that, but I think that most people feel like you do. I think most people feel that attachment to their home. So there's no question that really becomes the opportunity in a financial plan to make a difference for those who are willing to do it, right?
And it's pretty essential that we look at that, because you may want to stay in your home forever, but there might be a time where you physically can't.
Oh, 2-story home? I'm sure I won't.
Absolutely.
You're going up and down those steps?
You may have an elevator installed.
Well, sure, yes, of course. Or what's that one with the on
those
the stairs?
That go up and down.
Yeah. I'm like, okay,
well,
does
that'll
that really
be good
work?
for the resale value of the house.
Yeah, there you go. But yeah, so you got to consider, that could eventually happen if you live long enough, and that needs to be planned for.
Right.
So you might be forced to downsize.
I'm sure I will.
and we do see that from time to time with the baby boomers.
John, we're going to have you back. John Gallia of Gallia Wealth Management, certified financial planner. Wonderful information. We will have you back.
Absolutely, John. Thank you so much for joining us.
Well, I enjoyed the conversation. Thank you guys for having me.
Yeah, and time flows in this show, especially when we're talking about things that I think are relevant to a lot of our listeners. So this has been another episode of Elder Talk. Till next time, take care.
You're listening to Elder Talk with Joe Cordell, providing intelligent answers for those thinking about their future. Sponsored by TuckerAllen, your estate and elder law advisors. And now, Attorney-CPA Joe Cordell.